Well, let's now take a look at how this development will affect Nigeria's oil revenues. Oil and gas expert Mecca Oluwola joins me in our studio now, and I also have, he's the managing director, partner Zenera Consulting. Thank you very much for joining us on the show today.
Thank you for having me.
And also joining me via Skype, I also have the managing director, Ignite Advisory Limited, Charles Majami. Thank you very much for joining me. Now, gentlemen, let's start off with you, Mecca. Now, what does this Deep Offshore Act say, really?
Basically, it's just a way to let Nigeria get what is due to her equitably. The Deep Offshore Inland Basin and Production Sharing Contract Act, which is the full name, is actually an improvement on what we had before. So when this first came to law in 1999, Nigeria was, oil prices were around $10 per barrel, less than $10. And it says if it gets to $20 per barrel, we will come back to the drawing table to review what is accruable to Nigeria, all right? But that never happened, all right? So we signed the first PSC, which is a production sharing contract, in 1993. We had another round in 2000, and then we had another one in 2005. And all of those contracts didn't take into cognizance the caveat in the original Deep Offshore Act that says that we will review if oil prices ramp up above $20 per barrel. So you can see the enormity of the loss and wastage that Nigeria has experienced vis-a-vis the IOCs, the international oil companies. So basically what this is addressing is a reversal of those losses, and to say that Nigeria should get what is due to her, in an equitable manner.
Charles, quickly weighing on this now. Do you think this amendment is coming at a time way too late, or is just right at the nick of time?
I think you have to look very closely at what the amendment is proposing, what the amendment says. The amendment seeks to eliminate the graduated water depth-based royalty agreements for deep offshore assets, which were graduated up to 10% and replace that by a flat rate of 10% across the board for all deep water assets. Additionally, it seeks to charge a royalty that is tied to the price of crude oil up to 10%. It also seeks to change the 20-year review clause that the previous speaker just mentioned and replace it with a review that will be applicable every 8 years. It also talks about a penalty for those who don't comply. Now, absolutely, it is timely that this kind of approach be taken, especially given the fact that 65% of Nigeria's deep water assets pay royalty payments of zero. So in other words, if you're producing at 1,000-meter depth or beyond, you're actually, by law, according to the previous act, entitled to pay 0% in royalty payments. Now, the question now at this time is, what is that going to do in terms of its impact on the industry going forward? Now, in real terms, from our analysis, what we found is that the potential value reduction on the assets amounts to potentially about 18%, which is equal to a revenue loss of about $2.7 billion on offshore assets for the partners who are producing. The real question, I think, really applies to global investors and their appetite going forward, potentially, on those assets. These deep water assets need to withstand, for investors, oil pricing in the region of between $50 to $55 per barrel. Okay. In a volatile market that we have now, the question going forward is, can we withstand that? Especially given the fact that Nigeria is struggling to be competitive in that space. My view is that in the short term, It's certainly very good for government.
Okay, Charles, permit me to butt in now. Let's bring in Mecca into this conversation. Now, Mecca, members of the Oil Producer Trade section of the LCCI are saying, well, in the short term, this looks like a good picture that is being painted here. Government has made a good move in the short term. But in the long term, this would diminish our economic viability. We still see the stall investment within the deep water sector as well, and much more. And at the end of the day, we will be shooting ourselves in the foot. So we shouldn't be enticed by the little gains here and there.
Okay, so it depends on how you look at it, right? What is equitable is equitable. What is law. What is justice is justice. If you flip the scenario very quickly, and is the IOCs, if it were the IOCs that were losing all of those economic gains in the last 20 years.
Would this continue?
Would they have continued? No. You know, the next thing you will hear is a court in London or in America, you know, giving a foreclosure order on some of our assets. That's how it plays out, right? But I think what this enables us to do is to come back and have very fruitful discussions and conversations with potential investors who are going to come in, right? If you look at, before we look forward, we must learn from what has happened, right? Nigeria has lost at least $62 billion, right? And which is what the president, through the AGF, is trying to recover right now. This current year's budget is about $29 billion. Next year's budget has been ramped up to $32 billion. That means it's still not up to the 62, it's about $59 million. So it can service our entire economy for 2 years. Now, in a country where you have an employment at, 23.1%, right? Imagine what that would do to the economy.
So this act does not reflect the business environment or realities.
No. What I'm saying is that I think it's a welcome development. It's a good start, right? We can have discussions regarding future investments and how we can make it more attractive. But fundamentally, the structure of the act and the spirit of it has to be complied with. Okay.
Now, Charles, you made mention of the priced royalties. Let's look at the base, which is at about $35 per barrel. And in addition to the existing water debt-based royalties, you seem to tilt to this being a burden for Nigeria.
No, let me be very clear. I'm not saying that it's a burden. I'm saying that Nigeria needs to produce more crude oil if it's going to increase its revenues. And currently, Nigeria is not the only beautiful bride in the room. When you look at the fiscal incentives around this, you have to compare them to other areas in Africa that have now become oil producers. And we have to adjust to that in a manner that is commensurate with the realities of the market. If somebody is getting better deal elsewhere, they will go elsewhere. So regardless of how, and I don't disagree with the impacts, favorable impacts in the short term that this kind of amendment will provide. My worry is for the long-term impact to the industry. And I think already yesterday, we've already seen Total indicate their willingness to divest themselves of OML 118, of which they own 12.5%. So it is the trend that I'm worried about, not the immediate impacts of this.
Mecca, now let's talk about improving our current cost. Reducing our current cost of exploration, of production. Do you think we can take any aggressive measures to really bring down this cost in the short term, in the middle term, in the long term, because we're still heavily dependent on oil?
So it's something that is possible, but I don't see very feasible because of criminality in the Niger Delta. If you see the losses
seem to weigh down a little bit. Vandalism isn't at its peak like those days.
Well, I think it's underreporting that is happening. I don't think that it has gone down, right? If you speak to players in the industry, you speak to the indigenous players, the Wandos, the Seplats, the Everton, you know, the Iteos, they will tell you what is really going on. Right?
So how can we make this a feasible plan to reduce the cost of exploration on our oil fields?
So I think what needs to be done, you know, first and foremost, is the fact that we need to address fundamental issues. Get the federal government out of the business of running the oil and gas, you know, industry. Yeah, privatize an NPC. I'm telling you, if it was a private entity, you wouldn't have left that much money on the table.
Now I understand why I say it's possible, but might not be necessarily feasible.
Yes, we need to go back again to the basics, and that's what we're saying. Do you understand? You know, so if you give the people who can run this profitably as a commercial venture, right, you will see a result. The same way any private entity, you know, is able to run. Look at the telecoms, right? Look at everything. Everybody paid a signature bonus when we privatized the telecoms, right? The only company that did not pay the $285 million was Nitel, and it was the only one that went down. That is very instructive. Do you understand? So it's a no-brainer. We have to come back to the fundamentals and say we need to restructure the industry as a whole, right? And we keep saying it until we declare a state of emergency in the oil and gas. We'll be dancing around the issues.
Okay, now, quite an interesting stance there. But Charles, now let's also bring you back in the conversation. Now, expecting to receive equitable share of this funds. Now, talking about the cost of exploration, you heard Mecca speak over here. Do you think we can aggressively, any means possible, bring down the cost of exploration, production in our oil fields? And don't forget about our reality. What is still lingering? Our refineries are still not meeting up capacity.
Well, I think the previous speaker was speaking about onshore assets. We're talking about deep offshore here. Now, when this act was decreed in 1993, it was done because it was believed that deep offshore assets were much more risky. I think since then, the costs, technology has caught up. And indeed, the cost of being able to explore at those depths has gone down considerably. This not to say that we should not look at optimizing further on our cost oil. Okay, and again, yeah, and if we're to look onshore, that will entail having to deal with host and impacted communities in a manner that makes them more acceptable to these types of activities in their communities, bringing down the impact of producing oil and gas on the environment, etc., on their communities, and looking at other such things such as technologies that will be able to bring down the cost. So I think it's doable. I think it will take both energy producers and the government to work in tandem to do so. But definitely it's an area that needs to be looked at. I am not such a believer that NNPC will be privatized anytime soon. The Petroleum Industry Governance Bill stipulated how to do that. I'm not sure that that's something that's going to happen anytime soon, so I wouldn't want to talk much about that.
Okay. Thank you very much for your contribution. It's been a pleasure speaking with you, Charles Majomi. We've been speaking to Charles via Skype from Abuja. Now, Mecca, before I let you go quickly, your last words now. At a time when the whole world is looking at renewable energy, Nigeria is still big on oil and gas and then the energy sector and trying to get things right. But we necessarily have not taken the best steps when we talk about using the proceeds from oil and gas to diversify the economy. We still are not aggressive enough. Your last words in a sum, what should we be doing right?
So we need to take a holistic look at it and move completely from dependence on oil and gas.
We still have heavy investments, but we utilize the proceeds.
So that's it. So right now, and it doesn't contribute significantly to our GDP. Unfortunately, it's just the government expenditure that we use oil and gas to fund. which is 95% of what government spends comes from oil and gas. But the rest of the economy is really not running on the oil and gas.
So know your cash cow and milk it right.
Go to agriculture, go to ICT, go to retail, manufacturing, go and develop all of those sectors. And ICT is one huge field that is waiting to be mined.
Okay. Thank you very much for your contribution, Mecca Olowola. It's been a pleasure speaking with you.